There are many ways to calculate value of a corporation, but what do you do for a company that does not have dividends? Maybe it's a sole proprietorship, or it could just be a private corporation, right, that doesn't have publicly traded prices. How can we determine the value of this? So we have a model. This model really is an identical model to the dividend valuation model, with the exception of using free cash flows instead of dividends. So let's think about a company. So we've been looking at a company. We're thinking about maybe buying into this company. So this company had free cash flows of $500,000, and it has grown to $600,000 over 6 years. So this company currently, or historically, has had a free cash flow growth rate of roughly 3.1%. We can calculate, or we can look up, the weighted average cost of capital of the company. So again, let's say we do that and it is 6.7%. So what growth do we want? 3.1 sounds reasonable, so let's use that number. What this does then is calculates free cash flow next year. And our formula, of course, is it's next year's free cash flow divided by the difference between the weighted average cost of capital and the growth rate of free cash flows. So this company has a value of 17.1 or $17,183,333. So what do we know about the company? The company has cash, right? Let's say that the company has $100,000 in cash. If I want to find the value of the stock, I have to subtract all these things out. The value of the debt, let's say value of the debt, let's say it's $4 million. The company has 0 preferred stock. So the value of the common stock is $13.28 million. How many shares of stock does the company have? Well, let's kind of stop before we get there. If this is a partnership, this is what you would pay to buy the entire asset or the entire company, $13.283 million. Now, if it's a corporation, maybe we know it's a private corporation. They do have shares. Let's say that they have 200,000 shares of stock. That would tell us that roughly per share of stock in this private corporation, it's roughly worth $66. If you wanted to buy 60% of the stock, right? 60% of 200,000 is 120,000. Multiply that by the value of the shares. That's what you'd be willing to pay to buy this company, or to buy the ownership of the company. Divide this by 2 and get that same number, is what 50%, that's what 50% would be. Multiply it by 0.6, that would give you 60%. So again, this is one way of calculating the value of a corporation.